Welcome everyone, this is John Sheely as Director of Research and Development. In our first video, we were talking about the concepts and the strategies that we often use in IamADayTrader.com. But our first video, we were just taking of raw data, just open, high, low, close. On this video, we're going to take a look at indicators. But as you know, we must review our risk disclaimers. Trading carries a high degree of risk, and trading may not be suitable for all persons. Past returns are not indicative of future results. Please review our risk disclaimer very carefully. Additionally, I place our hypothetical disclaimer as well. In IamADayTrader.com, we create a great amount of research in the creation of indicators and strategies. Like other research firms, we use hypothetical data to create our discoveries. Please review our hypothetical disclaimer very carefully. Here we're looking at crude oil, and there are no indicators at the moment. What is the most popular indicators used by most traders? It's moving averages. Let's take a look at a few of them. And we're looking at crude oil, and we've added a 50-period simple moving average. This is one of the most popular moving averages because many stocks use a 50-period simple moving average. You hear this on television very frequently about the 50-period simple moving average. Let's take a look at a few stocks here. Here we're taking a look at Microsoft on a daily price, and you can tell that we've moved from a bearish trend to a bullish trend, and you can tell by the prices moving above the 50-period simple moving average, as well as the slope of the simple moving average. And you can basically indicate that we've been in a bullish trend, at least a trend bias, since late July. Let's add an exponential moving average to show you the difference. Now we're looking at the same chart for Microsoft, and the red moving average is actually an exponential moving average. And what you can tell is that they are very, very close. And prices were moving in the same general direction. And let's take a look at a few charts here to give an idea of the real differential between a simple moving average and an exponential moving average. We'll take a look at a chart that is based upon a 20-period versus a 50-period. Here looking at a price series, and the reason I couldn't tell you what it was is because it's not important. Here you're looking at the 20-period simple moving average. Look at the 20-period exponential moving average. They're almost the same values within a half average true range. In other words, it isn't important that it is whether or not it has to be a simple or an exponential. Let me show you another style of creating an average, and I'll show you the difference. What I've done is put a 25-period simple moving average, but it was displaced by 5 days. Notice that it is almost exactly in the same area as the 20-period exponential or the 20-period simple moving average. So what does this mean? Listen, whether or not our strategies use an exponential or a simple or any other strategy required by an averages, it doesn't make that much difference in regards to whether or not you're going to make money because we use an exponential or whether or not we make any money versus a simple. As you can tell, these are almost totally identical in regards to the trend and the timing of the trend direction. So we've moved back at taking a look at the Microsoft with an exponential or a simple moving averages. I've mentioned a 50-period simple moving average. Does it make any difference whether or not it's 49, maybe 48, 52, 53, 55? Not necessarily at all. Basically, what we're going to talk about is the prices are in a zone of whether we see a bull trend or a bear trend. Let's take a look at this. Now we're looking at Microsoft again with the 50-period simple moving average, and take a look at the two indicators. One is the DMI, Directional Movement Index. I'm showing you a 20-period, and what you're seeing is that the blue gets above the red lines here, gives you an indication of a potential change to a bullish trend. And what you're seeing is within the same area here, it looks like they are going in the same direction. Here we had a prices touching the moving average, and sure enough this goes back and forth, but it generally tries to hold the bullish trend. Here we're looking at the CCI, and many traders use that and watch that as a zero line. So in other words, if the indicator gets above zero, that indicates a potential bullish trend. Well, what do you know? The CCI is getting above zero, and it's doing this at the same time and same area as the DMI and the 50-period simple moving average. Even as prices touch around the 50-period simple moving average, you can see that the CCI is going above and below the zero line. Even if it comes down here in November, December, you're taking a look at prices touch the moving averages, and the CCI is basically holding around the zero or above. This is why I'm telling you this. This is an area, a zone, that this is going to become a bullish trend. This is a potential zone. This may or may not turn into a bearish trend. Let's take a look at a few other charts here. Here we're taking a look at crude oil, and previously the market was in a bearish trend. Prices have moved the 50-period simple moving average. Take a look at this same time. CCI is getting above zero. Here the DMI is now getting bullish. We had a few starts in regards to prices getting underneath the 50-period moving average, but it didn't take long. But during that particular time, the price was trying to get bearish with the DMI, and it was trying to get bearish as the indicator was getting below zero. I'm going to show you one other thing. Have you heard of the group known as the turtles? Turtles are traders who look at prices based upon the previous swing lows or swing highs, generally within 20 to 25 days. And what you're looking at is prices beginning to move above not just the moving averages, not just the CCI, not just the DMI, but prices are now moving above the highs of the previous 20 days. Here you're taking a look at decline, in which we now are turning into a bearish trend, and our indicators are moving bearish, and they're completely different than the moving averages. But take a look at what prices have done in the last 4 weeks or the last 20 days. As you can tell, prices are beginning to move below this area. This, everyone, is a zone of potential change to a bullish trend. This is a zone of prices that are potentially changing to a bearish trend. Have you ever heard of the term, the funds are buying or the funds are selling? When we are talking about funds, we're talking about hedge funds, and there are thousands of funds who use technical analysis for quantitative analysis to enter trades in the direction of a trend. What I'm showing you is that zone is when these funds come in. Now granted, one fund in Singapore may be a day earlier than another one. There is a hedge fund in London who is going to be putting on a position, and New York may be putting a position on at the same time or within several other days. When you hear about the funds are buying and selling, we are talking about millions of dollars, if not billions of dollars, will be involved with analyzing the trend. This is a zone of which prices will meet into a bull trend. This is a zone in which many different traders, hedge funds, algorithmic traders will be looking for a potential trade. Now, because of that, you can tell that this zone can be 1 or 2 days early or 1 or 2 days late. Is that the most important question in regards to putting on a trade? We'll talk about that on our next video. This is John Sheely, Director of Research and Development.